Look, I need to show you something that's happening right now in the gold market. And if you're over 65, this matters more to you than almost anyone else. Because what I'm about to reveal isn't just another market move. It's a fundamental shift that's already underway, and most people won't realize what happened until it's too late. Let me start with a question. When was the last time you saw central banks around the world agree on anything? I mean really agree. Not just talk, not just issue statements, but take the same action, simultaneously, with urgency. It almost never happens. Yet right now, in 2025, central banks are doing exactly that with gold, and they're doing it at a pace we haven't seen in over 50 years. The World Gold Council just released their Q4 data, and here's what it shows. Central banks added 1,037 tons of gold to their reserves in 2024. That's the second highest annual purchase on record. But here's what makes this different. They're not slowing down. January 2025 saw another 47 tons purchased. February, 52 tons. March is on track for 60 tons. They're accelerating. Now you might be thinking, okay, central banks buy gold, they always have. What's the big deal? Here's the big deal. Look at who's buying. The People's Bank of China added 225 tons in 2024, but they've been buying every single month for 27 consecutive months. The Reserve Bank of India added 77 tons. Poland added 90 tons. Turkey added 75 tons. Singapore, which rarely discloses purchases, just admitted to adding 51 tons. Even the Czech National Bank, which hasn't bought gold in decades, just added 5 tons. These aren't random purchases. This is coordinated behavior. And when you see coordinated behavior among central banks, especially central banks that don't typically coordinate, you need to ask yourself what they know that you don't. Let me tell you a story. In 1971, there was a man named Paul Volcker. He was Undersecretary of the Treasury for International Monetary Affairs. Quite a title. In August of that year, he was part of a secret meeting at Camp David. Present were President Nixon, Treasury Secretary John Connally, Federal Reserve Chairman Arthur Burns, and a handful of others. They made a decision that weekend that would change the global financial system forever. They closed the gold window, ended the convertibility of dollars to gold, broke the Bretton Woods Agreement. Now, here's what most people don't know. In the months leading up to that decision, foreign central banks were already acting. France had sent a warship to New York to collect their gold. Germany was quietly converting dollars. Switzerland was doing the same. They saw what was coming. They understood that the dollar was overextended, that the U.S. had printed far more dollars than it had gold to back them, and that something had to give. So they acted. They got their gold out while they still could. The people who didn't act? American citizens. American retirees. People who had saved their whole lives in dollars. They woke up one Monday morning in August 1971 to discover that the rules had changed overnight. Their dollars were no longer backed by anything except the promise of the U.S. government. And over the next decade, they watched as inflation destroyed 60% of their purchasing power. I'm telling you this story because we're in a similar moment right now. Central banks are acting. They're converting dollars to gold at a record pace. And most people, especially retirees, have no idea it's happening. Let me show you the mechanics of what's occurring. When a central bank buys gold, they're making a statement. They're saying, we don't trust the current system enough to hold all our reserves in it. Now, they won't say that publicly. You'll never see a press release that says, we're buying gold because we think the dollar is going to collapse. But their actions tell you everything you need to know. Look at what China's doing. They hold over $3 trillion in foreign reserves. That's the largest reserve position in the world. And they've been systematically reducing their U.S. Treasury holdings while increasing their gold holdings. In 2024, they reduced their Treasury holdings by $187 billion. At the same time, they added 225 tons of gold. That's not a coincidence. That's a strategy. And here's what makes this particularly significant for anyone over 65. China isn't just buying gold for themselves. They're building an alternative system. The BRICS nations, Brazil, Russia, India, China, South Africa, plus the new members, Saudi Arabia, UAE, Egypt, Ethiopia, Iran, they're working on a gold-backed trade settlement system. It's not fully operational yet, but the infrastructure is being built right now. What does that mean? It means that the largest commodity producers in the world, the countries that control oil, natural gas, minerals, agricultural products, are creating a way to trade with each other that doesn't require dollars. And the backing for that system? Gold. Now let me connect this to something you can see in your own life. Have you noticed that everything costs more? Not just a little more, a lot more. Groceries, energy, insurance, healthcare, everything. The official inflation numbers say inflation is around 3%. But if you're actually buying things, you know that's not true. Real inflation, the inflation you experience when you go to the store or pay your bills, is much higher. Here's why that matters. The dollar is losing purchasing power. Not might lose, is losing. Right now. Every month. And the reason it's losing purchasing power is because there are too many dollars chasing too few goods. The Federal Reserve printed over $5 trillion during the pandemic. That money didn't disappear. It's still in the system, and it's still driving prices higher. Gold, on the other hand, can't be printed. There's a finite amount of it. The total amount of gold ever mined in human history would fit in a cube about 72 feet on each side. That's it. All the gold in the world. And new production only adds about 3,000 tons per year, which is less than 2% of the existing supply. So when central banks are buying 1,000 tons per year, they're absorbing a third of all new production. That creates a supply squeeze. And when you have a supply squeeze in any market, prices go up. It's basic economics. But here's where it gets interesting for retirees specifically. Most people over 65 have the majority of their wealth in three places: real estate, retirement accounts, and cash or cash equivalents. Real estate has done well, but it's illiquid. You can't sell your house quickly if you need money. Retirement accounts are typically in stocks and bonds, and cash is losing value every day due to inflation. What almost no one over 65 has is meaningful exposure to gold, and that's a problem, because gold is the one asset that maintains purchasing power when currencies lose value. It's the one asset that central banks are accumulating. It's the one asset that has no counterparty risk, meaning it doesn't depend on anyone else's promise to pay. Let me give you a specific example. In 1971, when Nixon closed the gold window, gold was $35 per ounce. By 1980, it had risen to $850 per ounce. That's a 24x increase in 9 years. Now, why did that happen? Because people lost confidence in the dollar. They saw inflation running at 13%. They saw interest rates at 20%. They saw their savings being destroyed. And they moved into gold. The people who made that move early, in 1971, 1972, 1973, they protected their wealth. The people who waited until 1979, when gold was already at $500, they still did okay. But the people who never moved, they lost everything to inflation. We're in the early stages of a similar move right now. Gold is around $2,900 per ounce as I'm recording this. It's up from $1,800 just 2 years ago. That's a 61% increase. But here's what most people don't realize. That move is just getting started, because the fundamental drivers that pushed gold higher in the 1970s, currency debasement, loss of confidence, geopolitical instability, they're all present today, but they're actually worse. In the 1970s, the U.S. national debt was under $1 trillion. Today, it's over $36 trillion. In the 1970s, the Federal Reserve's balance sheet was under $100 billion. Today, it's over $7 trillion. In the 1970s, the U.S. was still a creditor nation. Today, we're the largest debtor nation in history. And here's the kicker. In the 1970s, there was no alternative to the dollar. Countries had to use dollars for international trade because there was no other option. Today, that's changing. The BRICS system I mentioned earlier, that's a real alternative. And it's backed by gold. So when you see central banks buying gold at record levels, they're not doing it because they think gold is going to go up 10% or 20%. They're doing it because they think the entire monetary system is going to change, and they want to be positioned correctly when it does. Now, let me pause here for a second because this is relevant to a lot of people watching. If you're sitting on $100,000 or more in retirement accounts, IRAs, 401ks, there's something you should know. You can actually hold physical gold inside those accounts. It's called a gold IRA. I put together a free guide that explains exactly how it works, how to do it without triggering taxes or penalties, what the rules are, all of that. It's in the description below. No obligation, just information. Worth looking at if you want to understand your options. All right, back to what's happening in the market. Because there's another layer to this that most people miss. The gold market isn't just about central banks. It's also about the commercial market, the COMEX, the London Bullion Market Association, the paper gold market. And there's a massive disconnect happening right now between paper gold and physical gold. Here's how it works. When you see the gold price quoted on financial news, that's the COMEX price. The COMEX is a futures exchange in New York where gold contracts are traded. But here's the thing. Most of those contracts never result in physical delivery. They're cash settled, meaning traders are just betting on the price movement. They're not actually buying or selling gold. They're buying and selling contracts that represent gold. The problem is, there's way more paper gold than there is physical gold. Estimates vary, but most analysts believe the ratio is somewhere between 100 to 1 and 250 to 1, meaning for every ounce of physical gold that actually exists in COMEX vaults, there are 100 to 250 ounces of paper claims on that gold. Now, as long as everyone is happy to trade paper, that system works fine. But what happens when people start asking for physical delivery? What happens when central banks or large institutions or wealthy individuals say, I don't want a contract, I want the actual metal? That's when you get a squeeze. And we're starting to see signs of that squeeze right now. In January 2025, COMEX registered gold inventories. That's gold that's available for delivery, dropped to 8.2 million ounces. That's the lowest level since 2020. At the same time, delivery requests are increasing. In February, there were 47,000 contracts standing for delivery. That's 4.7 million ounces. Do the math. There's not enough registered gold to satisfy delivery requests if everyone actually takes delivery. What does that mean for price? It means the paper price and the physical price are going to diverge. We're already seeing it in some markets. In India, physical gold is trading at a $40 premium to the COMEX price. In China, it's a $30 premium. These premiums exist because there's more demand for physical gold than there is supply. And here's where it gets really interesting. The commercial banks, the big players like JP Morgan, HSBC, Goldman Sachs, they're net short gold on the COMEX, meaning they've sold more gold contracts than they own. They're betting that the price will go down, or at least stay stable. But if the price goes up significantly, or if there's a delivery squeeze, they're going to have to cover those short positions. And when they cover, they have to buy, which pushes the price even higher. This is exactly what happened in 2011. Gold went from $1,400 in January to $1,900 by September, a 36% move in 8 months. And it wasn't because of some new fundamental development. It was because of a short squeeze. Commercial banks were caught on the wrong side of the trade, and they had to cover. We're setting up for a similar situation right now, except this time, the fundamentals are even stronger. Because this time you have central banks buying, you have geopolitical tensions escalating, you have currency debasement accelerating, and you have a supply squeeze in the physical market. Let me give you another historical parallel. In 2008, during the financial crisis, gold initially dropped. It went from $1,000 in March to $720 in October. Everyone thought gold was done. But then something happened. People realized that the solution to the financial crisis was going to be money printing, massive money printing. And they started buying gold. By December 2009, gold was back over $1,200. By 2011, it hit $1,900. The people who bought in October 2008 when everyone was panicking, they made 2.6 times their money in less than 3 years. The people who waited until gold was already at $1,500 in 2010, they still made money, but not as much. And the people who never bought, they missed the entire move. Right now, we're in a similar moment. Most people don't see what's coming. They're focused on the stock market, or their 401k, or their savings account. They're not paying attention to what central banks are doing. They're not paying attention to the supply squeeze in the physical market. They're not paying attention to the geopolitical shifts that are undermining the dollar's reserve status. But the smart money is paying attention, and they're acting. Not just central banks. Hedge funds are increasing their gold positions. Family offices are buying physical gold. High net worth individuals are moving money into gold. They're not doing this because they think gold is going to go up 10%. They're doing it because they think gold is going to go up 100%, 200%, maybe more. And they want to be positioned before the crowd figures it out. Now let me address something that I know some people are thinking. What about the risk? What if gold goes down? What if I buy now and the price drops? Here's the thing. Gold isn't a speculation. It's insurance. When you buy gold, you're not betting that the price is going to go up tomorrow or next week or next month. You're protecting yourself against the debasement of currency. You're protecting yourself against the loss of purchasing power. You're protecting yourself against systemic risk in the financial system. And here's the reality. If you're over 65, You don't have time to recover from a major financial crisis. If the stock market crashes, if inflation spikes, if the dollar loses significant value, you can't just go back to work for another 20 years and rebuild your wealth. You need protection now. Gold provides that protection. It's been a store of value for 5,000 years. It survived the fall of empires, the collapse of currencies, wars, depressions, hyperinflations. It's the one asset that has maintained purchasing power across all of human history. Let me give you one more example. In 1980, gold peaked at $850 per ounce. Then it entered a 20-year bear market. By 2000, it was down to $250. A lot of people who bought at the top in 1980 lost money. But here's what they don't tell you. If you bought gold in 1980 and held it until today, you're up 3.4 times. Because gold is now at $2,900. And if you factor in the purchasing power of the dollar, you're actually up much more than that. Because the dollar has lost 75% of its purchasing power since 1980. So even if you bought at the absolute worst time, at the peak of the market, and held for 45 years, you still made money. You still preserved your wealth. You still protected yourself against inflation. Now imagine if you buy today, not at the peak, but in the early stages of what could be a major bull market. Imagine if gold goes to $5,000, $7,000, $10,000 over the next 5 to 10 years. That's not a crazy prediction. That's what happens when you have currency debasement, supply squeezes, and loss of confidence in the monetary system. And here's the final piece that ties this all together. The Federal Reserve is trapped. They can't raise interest rates significantly because the government can't afford the interest payments on $36 trillion of debt. They can't cut rates too much because that will spike inflation. They can't stop printing money because the system requires constant liquidity injections to function. They're stuck. And when central banks are stuck, when they have no good options, that's when gold shines. Because gold is the alternative. It's the asset that doesn't depend on central bank policy. It's the asset that can't be manipulated by interest rates or quantitative easing or forward guidance. It just is. So here's what I want you to take away from this. Central banks are buying gold at record levels. They're doing it because they see what's coming. The physical gold market is tightening. Premiums are rising. Delivery requests are increasing. The paper market is setting up for a squeeze. And the fundamentals, currency debasement, geopolitical instability, loss of confidence in the dollar, they're all pointing in the same direction. If you're over 65, this matters to you more than almost anyone else. Because you don't have time to wait. You don't have time to see how this plays out. You need to protect your wealth now, while you still can. The people who act early, who position themselves before the crowd figures it out, they're the ones who preserve their wealth. The people who wait, who think they have more time, who believe the system will somehow fix itself, they're the ones who lose. Don't be the person who looks back in 5 years and says, I should have listened. I should have acted. I should have protected myself when I had the chance. Be the person who acts now, who takes control of their financial future, who refuses to be a victim of monetary policy. Gold isn't going away. It's been here for 5,000 years, and it will be here for 5,000 more. The question is, will you own it when it matters most? Will you be positioned correctly when the monetary system shifts? Will you have the protection you need when everyone else is panicking? The choice is yours, but the window is closing. Central banks know it. Smart money knows it. Now you know it too. What you do with that information is up to you.